This is the London FinTech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is the London FinTech Podcast, episode 171, brought to you in association with Smart Pension and the unlistedboard.com. And I'm delighted to be joined today by Josh Bell, General Partner and Head of FinTech at Dawn Capital, London-based, European-wide venture capitalists, to discuss the evolution and future of venture capital and the practical points arising therefrom for fundraising funds. As VCs are key to many/most fast-growth tech firms as a whole, this is a super important topic and relatively straightforward, so I don't need to explain it. So let's dive in without further ado. Plenty to talk about, so let's get on with the show. Good morning, Josh. Thank you for joining me on the show today.
Pleasure to be with you, Mike.
So we're recording this a little bit before Christmas, on the first day of the 58th lockdowns, it feels like, in London. And you're sitting in an office, which probably not many people are doing in London at the moment, but at least by the looks of it, it's nice and quiet.
Well, it's a heck of a lot quieter here than being at home with very young children. So I'm in the office, but I am by myself. Sadly, after what we're going to discuss over the next hour, I'm not going to be able to go out for a pint afterwards with Tier 3 having kicked off.
I've given up on the rules, but I think you could probably get a takeaway pint, so you can stand around in 5 degrees centigrade, damp London December, and catch your death of pneumonia if you're not careful, drinking a nice sort of not so warm pint. But yes, talking about Christmas, let's have a positive thing because it means so much negative spin. You're at the fortunate stage where Christmas is starting to be jolly and will be jolly for the next few years as you've got young kids. Bridget and I are at the stage where you're trying to lasso your kids so they pop in and say hello at some stage. It's a very different scenario. And most of my buddies who got down to it just a little bit earlier are in the sort of bounce a grandchild on your knee stage, which apparently is also quite fun.
We're a long way from that yet. But the older one is 2, so we're introducing her to stockings and Elf on the Shelf and a bit of Father Christmas delivering the presents next week.
Excellent. Well, in a few years' time, you will suffer, no doubt, what you did to your parents, which is the little blighters, certainly I did, would wake up at 4 o'clock in the morning and try and open the presents under the bed and really quiet and have a parent come in and tell you to go back to sleep, it's too early. So anyway, that's Christmas, but by the time listeners listen to this, it's 2021 and they will have had their Christmas. I hope you all had good Christmases. And as a different intro kick-off, and just to go to the super macro mega picture of tech businesses and VCing and stuff like that, you were going to start telling us a little bit about something unfintech, but of fascinating relevance, which is that a company called Airbnb floated last week for quite a few dollars.
Yeah, absolutely. I mean, I think Christmas has come early for a lot of the VCs involved with Airbnb. It's a fantastic testament to what's been built by the company that at the end of a year in which effectively travel has been hit massively and particularly business travel, actually you can have a company like Airbnb, which is pivotal to the sharing economy and people staying as an alternative to hotels and so on, floating and within 48 hours being worth $100 billion. To put that in context, I think that's a market cap greater than the 7 or 8 largest hotel groups globally in aggregate, just by Airbnb, a business without pretty much any physical assets. So, it's a little far from what we typically invest in day-to-day here. We don't do marketplaces. I think in Airbnb, that would have been one of our checks by exception we'd have been delighted to do. But it's a great example of how, some seed capital in the early days can germinate a fantastic business.
Yes, and I remember talking of children, I remember hearing that thing from my kids about Airbnb some time ago, and I thought, oh yeah, you can sort of, rent your place out on the internet. Okay. I would never have guessed in 100 billion years that it would be going for 100 billion, let alone it would be worth 100 billion during a period when sort of amongst various types of pleasure that have been banned, holidaying has been sort of nigh-on banned for most of the people most of the time. So that's an even more phenomenal result, isn't it?
I mean, it's amazing. I mean, it shows the power of the economics of the sharing economy, where you can have a platform which simply connects demand and supply, and a slice of revenue is taken off the top, and there are enormous network effects on both sides. I actually did look up the numbers just to make myself extra jealous of the very early stage VCs. There's a terrific accelerator, maybe the best in the world, a firm called Y Combinator out of Silicon Valley, who bought initially for for $20,000 investment, effectively, they had 2% of Airbnb. So that was kind of at $1 million or so valuation. And, there's been a bit of dilution along the way, but that $20,000 today, this week, is kind of worth in the order of $2 billion. So that's kind of 100,000 times return on a 10-year-long investment. So, and Mike, you're a former fund manager yourself. I mean, those are kind of getting on close for 100% annualized return. I mean, that's just, it's a good advert for venture capital, I guess, and for Y Combinator's investors.
Yes, I know it is astronomical and literally incredible. It's the kind of returns I think one sees when there's a turning point in technology and that we haven't seen the like of, with a little bit of the dot-coms, the Amazons, of course. But since the 19th century, when Industrial Revolution was being rolled out and railways and all that kind of stuff, and, the vast majority failed, but actually the ones that succeeded became mega. So it is one of those interesting points in time where a bunch of stuff is happening, but then it's a bit like in a new dimension, the sort of white space on the map. But actually, before you know it, you've got countries, you've got Amazon, you've got Google, you've got Airbnb, and then actually, a bit like Victorian explorers, after a while you've run out of sort of new territory to explore until something else comes along. And of course, we're now in virtual territory, this sort of ideas and abstractions, and no longer you need vast machines and sort of steamships and all that. So that's quite fascinating. But I think the one thing that there's a corollary from that, and it is amazing and it's a great story. Let's just ask you your opinion on this one. The thing that concerns me about this kind of stuff is that once you've got an Amazon and a Google and an Airbnb, the easy thing to say is, oh yeah, they'll be innovated, new ones will come along and replace them, da-da-da-da-da. But I don't think that's what happens at technology turning points. I think it happens conventionally, as long as big co's aren't propped up by regulation, but that's a separate conversation and a sort of whole podcast in itself about the big co, small co structure. But for example, let's take railways in the UK. Huge numbers were grown, then it was pruned back, and then it's, the ownership changed, but actually we've got the same railways now. I mean, nothing's going to disrupt railways. We're going to have railways forevermore. And in the same way, I assume that in a century's time, okay, the internet will have changed and all that kind of thing, but, maybe for the sake of argument, Amazon is still there, or it's changed its ownership a few times. In a world where you get these network effects, so there is a Facebook, there's a Twitter, there's an Instagram, there's an Airbnb, and they hoover up, literally in an imperial sense, vast swathes of the global map in this new space. What does that leave on the table, literally quotes for every other business? Because you can be an astronomical one. Is there much left? I mean, of course, the answer is there is, but do we not have this sort of differentiation into a few phenomenal players who'll sort of hang around one way or another, and then everyone else is kind of almost going for much smaller scraps on the plate?
I think the history of technology companies is kind of littered with examples of businesses which at the time, for example, MySpace, had the network effect, had all of those dynamics, but actually don't survive the long haul because of an inability to innovate. So I don't think we're sort of at an equilibrium state where Facebook can't be challenged. I mean, Facebook is defensively, acquiring up smaller players which are perhaps more innovative than it is itself. For example, with their acquisition of Instagram a few years ago. And, we don't actually see within Facebook's numbers or within Google having acquired YouTube, actually the degree to which these companies are, engines behind the growth of the overall business. So I don't think that we'll necessarily ever reach that stasis point. And I think we're seeing an acceleration of innovation. And even in the last 10 years, where we're standing today, wouldn't have been projectable. So I wouldn't want to make any projections about the future. What I would say is, software today is a $1 trillion revenue opportunity, particularly with COVID accelerating digitization and the move to software. And we're not seeing, an upper bound, certainly within our businesses, but more broadly in kind of business to business and enterprise software and so on. Actually, these companies' ability to scale, they are hoovering up what was previously done offline.
Yes, exactly. Well, I certainly agree on the 10 or 20 year view, which is probably all I care about at the moment in particular. And the 100-year view is always hard to say, because the point is, I think that virtual is very different. So, let's just take the railways, as I've started with the railways. There are train tracks around the UK. UK is a tiny country, England's certainly tiny. You can't lay down a new bunch of railway tracks to innovate out the railway grid in the same way the electricity generating grid, which connects a supply of electricity and demand for electricity around the country. That infrastructure is physically there, And that very much limits how it can go. But in the virtual case, well, firstly, going back to industries like, looking at US steel and the antitrust legislation at the end of the 19th century in America and all that jazz, they get broken up. And without talking about the US election, there's clear, blatant political skew in the big platforms. There's calls to regulate the big platforms, break them up, do this, that, the other, who knows. So there's the government intervention, the lack of infrastructure. So yes, I think things are going to keep changing, and who knows about 100 years' time. I don't think we will find out unless we're little angels floating in the sky. Now, talking about the sort of the big picture term, we've started with sort of being under 2. At one stage you were under 2 and being shown a Christmas stocking and elf on the shelf. And at some stage in a century you'll be floating up in the sky with wings, seeing how all your investments did. And hopefully not like Vincent van Gogh being massively successful in your investments over the longer term. So fast forwarding through all these sort of Christmas stockings and leaving aside the sort of eternity in the sky wearing a pair of wings, what has the career journey been like in the middle that's led you to an empty office today?
Oh, gosh. Well, kind of post all the college-y academic stuff.
Which you did quite a bit of, to be fair. You're being modest. You went to sort of slightly well-known places like, Oxford, Harvard and Cambridge, which were certainly doing the rounds.
Yeah, so I managed to avoid actually getting a real job for quite a long time. At the end of a bit of a grand tour of those places, I joined McKinsey, the Jesuits of capitalism, to kind of learn the craft. So I had 5 or 6 years of really getting under the skin of working with large organizations, learning how to do kind of 2x2 matrices and, write PowerPoint presentations. After a few years of doing that, I actually really wanted to switch to the principal side of the table. And I got together with my partners, Håkan and Norman, and we established Dawn. So we fundraised through 2007 and launched a fund the end of that year. So we're now 13 years in, over $1 billion of capital we've raised to invest European-wide Series A, Series B, Series C businesses. So, my CV so far has just McKinsey, where I learned my craft, and Dawn, where we're working with early and mid-stage companies in software companies and helping them to grow.
Excellent. Well, we'll dive more into Dawn later once we've set the big picture about VCing. But I think it's worth mentioning in passing that you've had some successes yourselves, even if you didn't invest in Airbnb. iZettle is very well known, and I happened to have lunch, perhaps my last lunch in London for some time, with a chap yesterday who was off to see Quantexa, who had been on the podcast back in the day. They're a great firm. You're invested there. And also, just in terms of sort of business models and sort of end of year thinking about the big picture, in the modern world, the stat I remember from Pension B being on the show is that the average university leaver, job entrant to the market, has over a dozen jobs in their life. And that has its benefits. You learn this, that and the other and that kind of stuff. But I think it shouldn't be neglected, certainly for the young folks as well, that the other model, whereby you do one thing and you do it for a long time, you get really good at it. The old sort of apprentice mastership route that lasted for centuries in Europe still applies. I mean, if you're a doctor, if you're a neurosurgeon, you'll do it for decades and hopefully you'll be a really good neurosurgeon at the end of it. Or if you're a lawyer or a barrister, you will do that for decades and hopefully you'll get much better. And in the same way, as no doubt you will show, I presume that the more you go into the office and the more years you do VCing, the more you know about it and the better you get. So I think, yes, the doing one thing and doing it well and doing it for a long time model, it doesn't really get much of a mention actually in FS these days. Everyone wants to keep shifting, but it's super important, isn't it?
Yeah, I think certainly within venture capital, pattern recognition is really where it's at. So there's a flywheel effect of learning how to deploy capital, getting the returns on those capital, how we work with companies, who are the great entrepreneurs. And, it's exit and then kind of rinse and repeat. We return capital, we return it to our investors, we then have more to reinvest. We have founders who've had great exits who then co-invest via Dawn and go on to find the next stage of companies. So, sort of by definition, the longer you do this over time, there's just a proportionately greater success, which you're kind of able to achieve because you just happen to have seen more. And particularly when we kicked off a little over 10 years ago, VC in the UK, certainly in Europe, was relatively sleepy. There was perhaps only 1/30th or so of the capital going to companies as there is today. I mean, now we're looking at kind of £10 billion plus a year going into UK companies. Back then it was in the low hundreds of millions. And a lot of that was with government intervention and state aid and so on. it's really now a very, very vibrant industry. And what we're seeing every day here actually is the US funds coming on board, coming to Europe, looking at great businesses to invest in. There are a ton of them here, and so much of our work is actually now co-investing with our US friends and having them follow on and investing into our companies and so on. It's just a different world to where we started out. It's simply not an industry where you can have a 2 or 3 year career. You just won't learn enough and won't have the experience and the relationships to kind of make it work.
Yes, and I like the pattern recognition point, which is that the more experience you have, the more, as it were, explicit models you get from sort of left hemisphere type perception. But the other thing that you get by being sort of older and wiser and more experienced is what we call a feel. You get a feel for something, which is I always think of as a more right-brained thing, which is not explicit, it's implicit understanding. And one of my favourite examples of that was in 2007 when I was doing a gig at Landsbanki, I mentioned before, reforming their risk systems for them. And the London head of risk was an old sort of city guy as well, had been around for ages. And I remember we were just having a coffee sitting in reception because it was sort of a busy office. And I looked at him and he looked at me, and we both said, there's something funny going on here, just got a bad feel about this in a kind of Obi-Wan Kenobi way. And something like 4 months later, the company went bust. Well, we then went on to, why do you think it's got it? Da-di-da-di-da-di. We come up with rational stuff. But I think the real thing is that after decades in an industry, you have a feel in the same way that a neurosurgeon who is 55 can have someone walk in and you'll have a feel for that patient. And that's largely because, part of the vast subconscious has built up its own implicit models on a whole bunch of kind of almost neural networky parameters that you're not actually consciously looking at. So it's a feel as well. Do you feel that you get more of a feel as well as explicit?
Yeah, I think the pattern recognition, a lot of it is kind of intuition developed over time. How does a situation actually smell? How do you see it unfolding? Fundamentally, we see, even though kind of the software and the elements of the cost base and so on of any company might evolve over time, there are still the same problems and challenges being presented, and when we've seen it 3 or 4 times before, we simply know the right way through. We have a very experienced partner team who have had over 60 years or so of venture capital investing. I would actually say, interestingly, perhaps one of maybe the top venture capitalists in the world is a British guy, a Welsh guy called Michael Moritz. So I'm sure he's chairman of Sequoia, and kind of. In 50 years, he's been on the boards of PayPal and Stripe and Google, and he's now chairman of Klarna out of Sweden. And, in a 50-year career and sitting on the boards of those companies and watching those entrepreneurs grow and build them, that's an enormous degree of pattern recognition you have in what makes a success, and then being able to translate that to the next story. And sitting down with a founding team who, might have an idea and a little bit of capital and working out how to grow that into the next $50 billion ad yen and so on, you have a huge head start in doing that because you actually were there, in the garage or whatever back in the Google days where you put in an early check. And also huge kudos to Michael Moritz. He's also the UK's largest, I believe the largest philanthropist in the UK. So he's really putting his money back to good work. And it's terrific that as chairman of the world's top VC fund, he's actually a British guy.
Brilliant. I didn't realise he was. Okay, so let's move on. All this talk about long periods of time is very relevant to our topic. So in terms of the evolution of VCing, we can talk about what happened last year and this year and then try and project that forward. Or maybe we can dig deeper roots and talk about sort of before VCs and then sort of when VCs came about and how it's speciated over time and how it's changed and how you think it will change and how you think that matters for companies out there looking to raise funds. I've mentioned many times before, not slightly glibly, but sort of very roughly speaking, that for the sake of argument, in the 50s, 60s, 70s, in the UK, there was only 3 I's, which had been set up by the banks, so it's sort of fairly statish kind of thing. My first knowledge of this sector was when I was in at Klein Watts in the 80s. The investment management division had a unit called KBDC, Klein Benson Development Capital. So development capital was the phrase I heard in the 80s. And then, of course, we've got dot-coms and the modern world. So maybe you can, rather than my sort of sketch on the back of a fag packet, you can make that a bit more explicit about going back to a world where VC didn't exist and then VC suddenly came into being and how it's changed historically and a little bit about where we are now and then obviously where we think it's going.
Yeah, absolutely. So, like many things, VC really developed in the US. I think it was Bessemer who established the first VC fund over 100 years ago. But it really started to get legs, I guess, in the 70s and 80s with firms like Sequoia, who I just talked about, Kleiner Perkins and so on. Then when they were doubling down investments in the semiconductor space, It then accelerated and really got the rocket fuel when you had the opportunity to invest in seed companies like the guys who were founding Google. That kind of took us through the 90s. You had the huge acceleration of VC capital going in and the returns in the dot-com boom, with a lot of the IPOs and fantastic returns being made for the VC funds out of that. In the early noughties, as the dot-com bust, and then there was kind of the recovery, as it were, what we then saw was the establishment of the VC industry in the UK. There were some early US funds had come over, such as Accel and Benchmark, establishing European outposts. We came along the scene, focusing enterprise software, kind of late '08. But since then, in the decade or so since we established Dawn, there's been a 20x or so in terms of the size of the industry. So that's funds being managed. Our first fund, which we developed with the support of actually the UK government, the British Business Bank, we had a £30 million fund, and now we have over $1 billion under capital. We have the scale of funds. There are literally dozens and dozens and dozens, just based in London alone, of seed funds kind of germinating these businesses coming through. And then lots of our peer funds at Series A, Series B stage, investing all across Europe. And now kind of with the successes we've been having, you've had Adyen now at $50 billion on the payments processing side, and Unity at $40 billion, which is a platform for games development and developers. That's now worth $40 billion. So you're seeing European businesses able to generate massive returns for their early backers and to create thousands of jobs and founders who kind of come away as billionaires and all feeding back into the system. It's a hugely exciting time. I mean, we're seeing, software businesses now going out at multiples which just, weren't there 3, 4, 5 years ago. But we're seeing an underpinning of that is, perhaps optimistically, but it's quite different in terms of fundamentals to where we were 20 years ago in the dot-com boom. These are businesses with very high recurring revenue, zero churn, selling more to customers each and every year. So those are the kind of businesses which Dawn is underpinning across fintech. We can talk about that a bit later perhaps in terms of companies we have there, and across the whole of enterprise software. And as I said a minute ago, the opportunity of these companies is simply unbounded, and is also accelerated by this nasty virus, simply because the world is just moving more and more quickly towards digitization.
Yes, so I think the thing that you make explicit there came back to some knowledge that would have been implicit for me, is there's actually been pretty much an exponential takeoff of late in the UK over the last 15 years, should we say, about what's going on. And I just recall another data point. I mean, I set up my own thing, my own business in the late 90s, which would be a tech fintech in modern terms. And I do remember one or two people at the time saying, oh, actually, you should be in New York, because if you're in New York, there are these VCs and they give you lots of money and you could grow 100 times faster. And I said, and I thought, well, I don't really fancy going to New York. So it still wasn't really a sort of much of a thing as far as my consciousness was aware there. So in terms of this very rapid growth, the first thing that occurs to me is that although you're not virtual, because you're clearly real, you are in a sense, like many businesses, an Airbnb as it were, or a national grid, which is you've got supply on one hand and demand on the other, that VCs sit in between a supply of capital, pension funds or whatever, and on the other hand there are people who want that capital, and your job is to be an intelligent switch and trying to connect supply and demand to make both sides very happy. So the observation that VCs per se have grown is clearly correct, and the fact that more businesses can grow is clearly a side effect of the VCs growing. But in a sense, the upstream phenomenon here, and of course VCs were part of this, must be that the sector called venture capitalists have more successfully made the case to the great pools of money. I think I saw the other day that global pension funds, for the sake of argument, are $47 trillion or something. You guys go and knock on their doors and say, oh yeah, you really should be investing in this because of da-da-da-da-da. So presumably what actually has been driving this has been a much greater asset allocation by the owners of vast pools of capital into this sector.
Yes, so certainly there's more capital available to be allocated. In part, that's because we have capital being very successfully returned into the sector. 10, 12 years ago, European venture capital was just seen as an asset class that was perhaps poorly understood, and it hadn't had successful historic returns. The early noughties vintages were challenging. But for firms, like ours now, who can deliver multiple consecutive funds in a row, where the distributed capital is already way in excess of what our investors gave us, we're then able to enter this flywheel where the investors and the pension funds and so on want to continue giving us the capital more and more quickly because they see the opportunity available. And there's, as you said, $47 trillion and so on. I mean, the amount of capital available to invest into an asset class that's suddenly doing extremely well is, to use that word again, unbounded. So, for us now, I mean, we're raising funds, but we have to cap the size of the fund because, we see an upper limit certainly of how much capital can be successfully deployed to be able to return the rates of return we've been able to get historically. So we have a happy investor base, a very happy investor base, and we have to limit among those people actually how much they can put into each and every one of our funds. So it's a great position to be in. It's not where we were 12 years ago when we were first having the conversations around establishing Dawn.
That's well said. I mean, I think the point I would make, which is, again, having been in fund management in the past, that VC is a bit like pension fund management was in the 80s before people really measured against indices and that kind of thing. And the article that always sticks in my mind is that the industry as a whole, every VC, does very poorly performance-wise. The best ones do very well. And there's this famous article by Diane Mulcahy, an ex-VC herself, in the HBR in 2014 saying that venture capitalists are well paid to lose money. The stats are 6 years out of date by now, but as I recall, I just sort of stuck in my mind that, the average US VC in the greatest tech boom in history has not returned the funds that they took from the investors. And I forgot what the percentage was. The percentage that didn't even get a carry was very high, I think more than 50% or something like that. So as you see in any boom in industry, there's been a boom in industry. The best, let's say the top decile, or certainly perhaps the top quartile, the best ones have been bloody good at it, whether it's prospecting for gold and on the West Coast or something like that, or VCing. But lots of people come into the field who aren't experienced, who don't manage to do the pattern matching and all that kind of stuff. Now, what are the challenges of a shakeout? I mean, if you're a foreign exchange trader, the market moves so much, you do so many fast trades. I hire a foreign exchange trader and he just loses money for 6 months, I'll forget it. But the VC industry has gone through this exponential growth. Its timescales, the speed of light is so much slower in terms of I give you some of my money and in 7 years' time it comes back to me, that the dynamics of such a market are much slower to evolve. But one would assume that at some point there will perhaps inevitably going to be a shakeout of the bottom 50%, shall we say, in America or in the US or UK or around the world.
I mean, certainly there will be, funds which fail to perform, and as you say, funds which don't deliver carry, which is, the profit share, because they've actually repaid back all the initial capital to investors. We're in the opposite position where all of our, early funds are actually, we're in carry, we're distributing capital back to investors. But, at a portfolio company level, you have the power law where a small handful of your investments generate the overwhelming proportion of your returns. And then kind of as you aggregate that at a VC fund level, you have that kind of at an accelerated level. So you have a very small proportion of VC funds who deliver the outsized returns across the industry. And then you have a whole bunch of other funds who are able to raise their first fund or first couple of funds and to draw management fees on that. But then, the point at which, the rubber has to hit the road and they have to show returns to investors, and it's extremely transparent how their portfolio companies are doing, and then they won't be able to raise perhaps a second, third or fourth fund. So, if by a shakeout there are, some of the weaker funds who don't make it, then certainly that will be on the way. But at the same time, you're seeing accelerated returns by the funds who have the DNA to find and help to grow the top portfolio businesses. And there are a small handful of funds based across Europe who can do that. There are some great funds in the US, and there are many funds who perhaps won't move beyond raising their first or second fund because they don't get those ingredients in place.
Yes, and hearing you say that, it reminds me, it's some kind of power law, the name has escaped me, but if you look at the mass of stars, the bigger stars will have bigger gravity, they will attract more mass in, they will get better faster. It's some kind of exponential power law, the distribution of masses of stars, and it's the same in industries because, going back to Sequoia as the prime example used before, once you have such a successes and so many contacts that everybody wants to go to you, you get the chance to choose some more, as it were. It's a bit like being a supermodel. If you're a supermodel, you've got a choice of boyfriends, which the average person would not have. And in the same way, when you're known to be successful, not only do people want to come to you, but actually then vice versa, that the VC talking about boards can bring much more added value to the board of the company and to the growth of the company above and beyond. Look, here's 100 mil, Mike, for your business. You've got it, and thanks very much. Let me know how you get on in 10 years' time. It's no, I've got Josh on my board. That's a rare thing because you can't do 1,000 boards. And Josh has got a better part of 15 years experience. He's been in all these successful businesses. You're going to add value to me as a person and hence to my business.
Yeah, and actually, when we're talking to companies about Dawn having a prospective investment into the business, we can say whatever we want to say about Dawn, but actually we say, look, here are the phone numbers of our founders who we work with. You're a founder, pick up the phone to her and ask her about, her experience of working with Josh at Dawn or Håkan at Dawn or Norman at Dawn over the last 5, 6, 7, 8 years. For us, that's the best proof of what we do, is when the founders whose companies we invest in and want to help grow can articulate to the next generation of founders who we want to invest in, why take money from Dawn. It's really why we've been able, in so many of our kind of prospective conversations, we put in a term sheet and we're then always able to follow that up with being able to put in capital.
Right, okay, so we've had this huge growth, we've discussed. There's a natural process where the strong get stronger and the weak fall by the wayside, and evolution within the market. We've got a very large, complex market now, indeed. If you were back in your McKinsey days, you'd have no doubt a 2D chart and to put it all on. And going back to my great business plan for next year, which is I'm going to make an absolute fortune out of London Fintech podcast hoodies. So I'm going to coming back to you in 6 months' time. I'm going to at least 20, 30 million to really go all the way. And I think, I better speak to some other people as well. I've got all these random names of VCs in my head, as you might imagine, but I don't have them on some 2D chart. So how would you actually describe to a listener who needs to approach this landscape, how to sub-segment in the landscape? We're no longer 20 years ago where there's only half a dozen in London and you go and speak to all of them. It's now there's so many. You've got to be efficient from your perspective, but also from the VC's perspective. You don't want everyone that's trying to raise money coming to you because it would just take too long to filter them all. So what's the topology?
So the topology, I guess, would be, if you're looking at kind of a 2x2, as it were, certainly along one axis would be, along the x-axis would be, what is the check size that you as an entrepreneur is looking to raise? Is it a seed check, kind of 1, 2, 3, 4 million, all the way up to big growth capital checks, 50, 60, 70, 100 million plus. And for an entrepreneur, as a successful journey, you'll be raising all the way along that. But what you will have are different funds, focusing at different stages. So seed funds, writing the initial checks of 1, 2, 3, 4 million. There's some, great seed funds across Europe doing that, all the way through to some of the larger growth funds writing those first checks of 50, 60, 70 million. Where Dawn sits along that kind of axis is, our first checks tend to be around the 10 million or so levels, sometimes maybe slightly less. But we also have, the ability to invest actually up to 100 million per company. So we can invest, both from our principal fund and what we have top-up funds and so on. So we can kind of join the journey from then going forward. You then have the y-axis as part of your topology. For the y-axis, you would have, we'd say it's kind of degree of specialization. So you might have very, generalist funds, particularly on the seed fund side, who are kind of investing across everything, all the way through to much more specialized funds. So, we see ourselves as a specialized fund. We invest simply into enterprise software across Europe. So, the choice, I guess, as an investor when you're as a founder when you're looking to raise capital is, at what stage and how much you're looking to raise, and am I looking more for perhaps a specialized investor versus a more generalist one? And those are kind of the two principal axes against which most of the VC scene sits. If we added in kind of a third axis, if you want to go 3D, and I guess would be geography, whereby some funds, for lots of reasons, are relatively local. You might have, there are literally funds who invest just within London because that's where they have their remit to invest in, or UK-wide or European-wide, or even some funds who invest globally. So, that's really how the whole kind of VC world fits into that cube, I guess.
Excellent. Well, that's very helpful. So if you're some newbie founder, maybe some of the listeners will be in this model, that they're interested in this kind of stuff, and maybe in a year or two they actually set up their business and they need these things. What's the best way to get a grip of the topology when you've just got a telephone directory and there's a sort of 1,000 VCs in London, or however many there are these days? How would you advise a nephew or a niece who's about to go and sort of raise funds, how to draw up a short list or a long list of, a dozen or 2 dozen VCs to speak to out of all the various ones they could?
The warmest intros and the best way into really speaking with VC funds tends to be via warm referrals. So, when any of our founders come to us and say, we'd like to introduce, the founder of this other company to us, or there are reasons why we should be looking particularly at this software and so on, that's hugely exciting for us. So, rather than the kind of the cold direct email, that never really ends in a particularly positive conversation. It's quite hard kind of that way in. Really try to find the warm intro, get introduced, and then start to meet people, across the VC funds, but target it to, you're talking to the VC funds who, in that 2x2 we just talked about, will be investing the right amount of capital which you're seeking, and also have the right kind of vertical or sector focus for you. But then, there are lots of routes into company. I mean, there's also, post-COVID, there are also all the usual ones around networking and building relationships and all of those ways in. But ultimately for us, it's an incredibly warm referral, is a great way to start a conversation with Dawn.
Yes, I think it's any kind of biz dev is like that, isn't it? I mean, it's the same thing with the podcast. In 6 months' time, you ping me on one-liner and say, hey, Mike, you haven't had these guys on the show. What are you doing? You're crazy. You've got to have them. Well, that's straight to the top of the thing, and I definitely check them out, as opposed to I get my sort of, my labour of Hercules. I've got to clear out the stables of the inbox again, and there's 150 emails to plough through of people I may have heard of, but I can't really remember what they do or never heard of at all. So warm intros. Right, okay, so all that's very interesting and very clear. And having started off with this sort of decades view of things, and the fact that you're one of the more experienced general partners in London now and been very successful in fintech and this enterprise software market and all that kind of stuff. And obviously thinking about the bigger picture, and it's the end of the year, it's a good time to think about next year and where things are going. How do you see the VC market developing over the next few years? What do you think the major trends that listeners should look out for are?
I think in terms of VC funds, you're going to see more of a menu of different funds which, pools of capital are available from. As we started out with, we have our flagship fund and then top-up funds, and we're looking at kind of other ways in which we can continue to support the longer-term journey for companies, particularly maybe even post-IPO. So keeping kind of companies within the stable for longer, even after kind of exits are monetized and so on. So I think you'll see that among a lot of top VC firms. I think you're going to see, more platform support. So that's where you have, for example, for ourselves, we have a director of talent, and she's able to work with all of our portfolio companies and enable them to be as optimized as possible with how they build their C-level teams and think about kind of their overall org structures more generally. Those kind of ways of helping companies, you're going to see VCs stepping up a lot more across. And then I think you're going to see this, as you have more and more successful exits, there's going to be this great flywheel of kind of talent who've worked within one organization, perhaps made some money from their exit, kind of then going to set up the next generation of companies. We saw that with our iZettle exit out of Stockholm, and then we were able to invest into the next generation of iZettle founded team members' companies. Plus, also, if the exits are large enough, they're also making a bunch of money, and they're able to invest into their own next companies, but also support the whole generation of next companies. So it's hugely exciting for all those reasons.
Oh, excellent. Well, that sounds a very sophisticated future and very succinct and very clear exposition, and I can see that would work very well, as I mentioned on the podcast before, apropos boards, in terms of my research. Just as the average VC fund doesn't do very well performance-wise, but the great one does great. In the same way, the average founder has said to me that the average VC in London says they'll bring added value, but actually it doesn't really amount to much, whereas the great VC brings a hell of a lot. So this talent is a very good example of how I can see that a differentiating factor in the future in not just performance of the funds, but in the attraction to people seeking money will be demonstrable added value, which is that I set up a VC and in a year's time I'll say to a friend, oh yeah, I'll add value. Yeah, sure, well, okay, I'll try to. But you guys, if you've got a head of talent, again, with lots of experience, that's going to demonstrably add more value. Right, I hope that's been useful to you listeners out there. I hope some of you will go off and be founders, and ones like the VCs today or the podcast in December about raising capital will be helpful to you and your journey and society at large as you employ people. And before I wrap up the show, I'd like to thank my brand partners for the podcast, Smart Pension, who are fast, secure and free. Check out their UK workplace pensions at autoenrolment.co.uk. The enlistedboard.com, resources to help you start making your board an engine of growth today. So, Josh, we've covered a hell of a lot. We've touched on Dawn once or twice. Are there any sort of simple, clear messages you'd like to leave in listeners' minds as we go away about sort of a little, who Dawn is precisely, who should be contacting you for funds and fundraising, and what it is that you need as a sort of fairy godmother wish for 2021 that will make you even bigger and better and more successful by the end of next year?
Thanks, Mike. Look, as I've said, Dawn is a specialised enterprise software fund. We invest across Europe with a special focus within fintech and companies who sell into the financial services function of larger corporates. So, if you have a company which is, has the DNA and the dynamics to be the next iZettle or Tink, like a European category leader, the nature of which we invest in, we'd absolutely love to hear from you. You can reach out to us through the website or just email me directly. josh@dawncapital.com. We're also always looking for fantastic new team members. Yeah, and so, my wish for 2021 is, we carry on investing into great businesses and, we carry on building out our team to carry on being one of the preeminent VC funds within Europe.
Great. Well, that's been a fantastic exposition. Thank you for that, Josh. As I say, I've been sort of vaguely aware of development capital, VC capital, whatever you call it, sort of most of my career, but never that explicitly until obviously in the podcast I've spoken to a few in detail. And certainly for me it's been very helpful and no doubt for many of the listeners in terms of having a higher resolution JPEG about what's been going on and where it's going and all this kind of thing. So I think that, as we say, you're clearly a great specialist in your area and been very successful in that, and long may that continue. But you haven't forgotten your McKinsey days in terms of your nice, simple, clear PowerPoint and explaining and adding value. So I wish you and Dawn every success in the future in 2021 and beyond.
Thanks, and to you and your family too, Mike.
Thanks for listening. If you have any challenges or needs with your unlisted company board, get in touch with me at mike@londonfintechpodcast.com.
We could sit in a bend there all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moonrise, watching a happy moonrise. Come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fade in between the earth and the sky. Kiss the city goodbye, wave the city goodbye. Wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight dance.